The ripples from the conflict in the Middle East continue to dominate the market narrative. Global assets have been under pressure, and energy disruptions look set to endure well beyond any ceasefire. To discuss navigating volatile markets, I'm joined by Luca Paolini, Chief Strategist at Pictet Asset Management. Luca, thank you for joining us. Now, Luca, you've expressed scepticism over markets' reaction so far, or indeed their lack thereof, in the early weeks of the war. You've now turned a little more sanguine on the news of the ceasefire. Tell me your rationale here and where you see markets going from here.
Well, first of all, let me say that we always respect market reaction. And I think when you look at the ceasefire, we know there are a lot of areas where there is not clarity exactly what's going to happen. Well, we know that now Iran and US are talking to each other. It was not the case a few weeks ago. There is a clear indication that we are moving towards a de-escalation phase. There will be still a lot of noise, a lot of tweets in the middle of the night, but the direction of travel, I think, is right. The market has reacted quite significantly. And our concern, in fact, is that the market, relative to previous shocks, have never been significantly oversold. There hasn't been capitulation. So, yeah, we are a little bit more optimistic about the outcome of this conflict. But at the same time, we're also aware that the upside for equities especially is quite limited at this point in time.
So a little bit more volatility going forward. Do you have any thresholds in mind or targets that you expect for instance, oil prices? Where do you think we could see them going in the coming months?
Well, realistically speaking, oil price will probably fall a little bit from here, but it's not going to be at the level of pre-war. I don't think it's going to go back to 60 or 70. I think 80, 90s is probably a more likely scenario. And obviously that's bad for the global economy, but it's not as bad as it could have been. So I think, again, positive, but we have to be aware that there are some risks on the global economy and inflation, which I think, though, could be quite limited.
Now, I'd love to come back to inflation, but first of all, I was fascinated to see that you highlighted Chinese stocks, or China in general, as an area of resilience in this war. Explain that thinking and where investors might find opportunities potentially if this conflict is to flare up again.
Yeah, I mean, a lot of investors think that China is very vulnerable because China is a big importer of oil. The reality is that China is also a big coal industry. So there are different sources of energy that they can use. And also in terms of electrification, China is well ahead, for example, of the US. But also I think that China in the past during crises tend to work as a kind of a safe haven. We see this also in Chinese bonds. And the reason is because China has kind of its own political, economic, and financial cycle. So even if China remains obviously a risky place to invest, when everywhere else is getting riskier, in relative terms, China becomes a little bit safer. And that's why I think Chinese stocks and bonds tend to do quite well in periods of market stress.
Interesting. Now, where else are you seeing other opportunities and risks as you think about your positioning now that we at least have a ceasefire for now?
Well, I have to say that we see some upside potential in equities, especially in Europe, if this crisis comes to an end. We also start to think that there is value in bonds because, you still have two rate hikes priced in Europe especially, which I think is not consistent with the growth picture that we have for Europe, which is still relatively weak. Inflation will spike in the next couple of months, but if the oil price goes back to 80 and 90, obviously the inflation risk will go back to normal. So we think that the market is a little bit too worried about rate hikes at this point in time. It should support bonds in the short term. So I think we are increasing a little bit our duration. We start to like a little bit more European stocks, but again, the upside for equities, I think, is quite limited, even after the good news of the last few days.
I'm glad you touched on inflation and central banks. It seems as though you're not overly concerned about these inflation risks that many market watchers have been proclaiming in the early weeks of the war. So you think we continue to have a bit of a steady path and hopefully not too many hikes going forward?
Yes, I think when you look at typically we compare the current crisis with 2022 and Ukraine and Russia. It's a very different macroeconomic scenario. Back then, employment growth in the US was 5% per annum. Now it's 0. We have negative real interest rates, now they're positive. And also that we are coming out of the pandemic with a huge excess savings in the system. Now it's completely different. So of course there is a risk of inflation, but we also think that this risk is contained because the growth picture is a bit weaker. So don't get me wrong, there will be a spike in inflation. I don't think the central banks will react to this, what I think is a temporary spike, but not a long-term risk to inflation.
Now, finally, of course, the Iran war has dominated markets lately. We've even had Trump come out now and make renewed remarks about Greenland. So obviously, turmoil is set to continue through this year. But when you look beyond that, are some of the biggest risks and opportunities that you see in 2026?
Well, in terms of risk, is a risk that I think few investors seem to mention is the midterm election in the US. Now, we know that Trump's numbers are not great. We know that the risk is that Republican will lose control even of the Senate. And this will create, of course, a huge problem for Trump. He won't be able to push for his agenda. And this actually can have a significant impact on market. Think about the regulation, tax cuts, and all these kind of things. So this is one of the risks. The second one, which I think is also a little bit not talk about too much, is growth. Because yes, if you look at the US, still 2% growth, Europe is okay, but let's not forget that we come from a period of strong growth, and I do believe that when you look at especially the labor market in US, but Europe as well, there is a lot of weakness there. And at the top of this, earnings growth. Expectation for 20% earnings growth this year and next, at a time where global growth is a little bit weaker. I think that's probably the major risk, a significant kind of downgrade in earnings expectation in the coming months.
And of course, AI, I know, is another one that you've highlighted. Risk, opportunity?
Both. I think in the long term, we believe that AI is truly transformational. I think productivity will go up, and this will support all basically companies and all of us, in fact. But the risk of disruption is there. And I think the risk here is that companies focus more on the risk of disruption without looking at the long-term kind of positive of AI. So in the short term, I suspect that a lot of stocks will remain under pressure. And I think the next earnings season will tell us a little bit more about it.
Luca, thank you so much for joining us. For Morningstar, I'm Karen Gilchrist.